See, we are starting the topic called interest rate risk today. See, what is the interest rate risk you can have? So let us now understand. See, suppose you have taken a loan. If you take a loan at fixed rate, suppose I have taken a loan from a bank and bank has offered me 7%. And in the market, the interest rates have gone to 5%. So what would you think? You are paying a higher interest, correct? So is this a risk or not? Please tell me. Hello? This is a risk or not? This is a risk. Suppose you have taken a loan on floating rate and the bank has offered you interest of 7%. Okay. And the interest rates in the market have increased to 10%. Now you have to pay the interest at the rate of 10% for the loan what you have taken, not at the rate of 7%. So this interest rate, if increases or decreases, can really like cause a risk to you, and you may be ending up paying a higher interest to the bank, which you won't like. And if you pay higher interest, higher finance cost can also impact your earnings. Am I right? If you have taken loan from the bank on personal use, it will be kind of reducing your savings, and if you have taken loan for business, it would be kind of reducing your earnings or profits. So now, how to protect ourselves from this particular interest rate risk is what we are going to study in this chapter. Not a big chapter, small one. Let us focus now. See, interest rates on financial assets like bonds, etc. Because bonds pay interest to you, or debentures, if you want, you can say, are influenced by the risk of assets. Yes. See, the bonds which is issued by the company, those bonds would be mortgage backed securities, or we can say either mortgage backed securities or asset backed securities. What is the difference between mortgage backed securities or asset backed securities? Mortgage backed securities is mostly on the housing loan taken by the people, mortgages. Already I have explained you the concept of securitization, whereby whatever the loans which are taken by the people from the bank, the documents of that loan which are illiquid assets are converted into liquid assets, and that those liquid assets are in the form of bonds, and these bonds are issued to people. Now these bonds have a risk, because the people who are supposed to pay money on their mortgages, if they default, then definitely the bonds would have a lesser rating, and if the rating is less for that bond, okay, definitely there is a higher risk on that bond for you. So the profile of the security is mostly dependent on the backup of the asset what it has. Okay, if the asset is risky, then if the people who have taken loan and have mortgaged their property documents with the bank, those documents which bank has taken and converted into bonds, if those people default or if they don't have good credit ratings, then your asset would have a bigger risk than it would have had if the people would have paid the payments to the bank timely. Okay, so risk of the assets. Acha, okay, let me tell you. Let us take a small example. This was like the technical one. You have a land document, you have a gold. Gold is more liquid, land is less liquid. So interest charged on land, for if you take a loan from bank and if you mortgage this land, the interest would be higher than loan which you take on gold, because gold is highly liquid. They can immediately sell in the market and get their money. Okay, for land they have to they have to look for the customers and the market, and it would take time for them to sell the land at a good price, etc. Now, duration of lending, the more the duration, the higher the duration or the time period for the maturity of the securities, the more the risk it carries and the more interest you should get. If you take a very big loan, you are charged highly. If you take less loan, you are charged lowly. If you take housing loan scenario in India, if you take loan beyond 40 lakhs, you would be charged interest at the rate of 7%. If you take loan less than 40 lakhs, that is between 20 lakhs to 40 lakhs, the interest charge would be 6.60, anything somewhere around. So you can see the difference here. You can check, Google out the information. Okay. And you always know there is a trade-off between risk and return. The higher the risk, the more the returns you should expect. And that is understood by the fact, because you should be compensated for a higher risk what you're taking. Now, so now when you have already understood about all these points, that there is definitely interest rate risk, like the which I've already shown you the example here. So how to control or how to reduce this kind of risk? That is what should be the motive of the company, correct? So now let's see how they would do that efficiently. Now, already I have given the the idea about floating interest rate debt. If the floating interest rate debt is nothing but the one which would be based upon the interest rate in the market, the loan which you have taken at 5%, and if the interest rates in the market have risen to 7, have like gone up to 7%, then you have to pay interest on loan at the rate of 7%. That's a big risk. And for fixed rate, if it is like 5, the bank, you took a loan at the rate of 5% and the interest rates have gone to 2%, then you are paying a higher interest rate. So these two are the issues which you have with these two types of interest rates: gap exposure, and the degree to which a firm is exposed to interest rate risk can be identified by using the method of gap analysis. See, gap analysis is based on the principle of grouping together assets and liabilities which are sensitive to interest rate changes according to their maturity dates. There may be some liabilities which definitely would have, which definitely which on which you need to pay interest. Suppose you have taken a loan, you need to pay interest on this, and you have purchased bonds of some company, and you are supposed to get interest on that. Okay. So now what we are doing is, in gap analysis, we are grouping together assets and liabilities which are sensitive to interest rate changes. Of course, when the interest rate change, this liability is definitely going to get impacted. When the interest rate change, the bonds interest what you're getting from the company in which you have invested would definitely be impacted, correct? So two different type of gap may occur: a negative gap, a positive gap. Very simple. If the assets are more and the liabilities are less, that means if the interest sensitive assets are more and the interest sensitive liabilities are less, you have a positive gap. If the interest, that means I can say assets more than liabilities, that to interest sensitive. If the interest sensitive liabilities are more than interest sensitive assets, you have a negative gap. Okay. So these two things you have to understand. With a negative gap, company faces exposure if interest rates rise, because you need to pay more liability, you need to pay more interest. Suppose you have a liability of 10 lakhs and you have assets of worth 5 lakhs. So here you are supposed to pay interest at the rate of 10%. Here you are supposed to get interest at the rate of 10%. So here you are paying 1 lakh and here you are getting 50,000. So still you are paying 50,000 additional, correct? That is a risk, correct or not? And here what happens, you pay less interest and you get you can recover that interest very easily if the assets are if you have assets of higher value when compared to liabilities. Why? Because if I get interest of 1 lakh and I need to pay interest of 50,000, I still earn 50,000 interest. That's a good thing. Okay. Now, what is this basis risk? Basis risk, see, it basis I would this basis comes into picture in many areas, but let us focus here as per our syllabus. It may appear that a company which has size matched assets and liabilities, that means assets and liabilities are matching, and is both receiving and paying interest, that's what I explained there, may not have any interest rate exposure. Yeah, because if you earn an interest of 1 lakh and you need to pay an interest of 1 lakh, that's it. You don't have any risk, because that is what you are equating. However, the two floating rates may not be determined using the same basis or benchmark. For example, one loan may be linked to 1 month LIBOR and the other 6 month LIBOR. So since they are linked to different LIBOR or different benchmark or different basis, definitely you won't have a perfect match like you are seeing here. Okay. That means maybe you may be receiving 1 lakh, or you may be paying 80,000, or you may be paying 80,000, you may be receiving 1 lakh. Somewhere or other, the perfect matching is not happening because of the different loans linked to different months LIBOR. Okay, London Interbank Offered Rate. So let's see what are the reasons why the interest rates fluctuate. There are many factors. The causes of interest rate fluctuations include structure of interest rates and yield curves and the changing economic factors. Yes, like risk. See, high risk borrowers definitely have to pay higher interest on their borrowing because they have a higher risk which they carry. So banks would like to charge high interest to them to get compensated for higher risk what they are taking on such kind of companies. Generally, you see startup businesses, they get loans at a very higher rate. Why? Because there's a lot of risk in this startup. Because if the startup fails, the CEO or someone who like we see many of the startups. So what happens if the startup like is in losses? The investors lose their money. CEO makes up good money, so he is not at risk, but the investors are always at risk. Okay. The need to make a profit on relending. See, banks would always accept deposits and lend. So they accept deposits at the rate of 5% and they lend at the rate of 9% to make a profit in this case, correct? So always they would charge higher when they lend. So the interest rates would be higher in this case. The bigger the size of the loan, because the more money they have given to you, the higher the interest. Different types of financial asset I've already explained you. Liquid assets carry less interest. Like if you kind of if you want to take a loan and if you put liquid assets as collateral, like I say gold or something, highly liquid assets which can immediately be converted into cash, then you can expect less interest. But if you know, if you mortgage your land or put them as collateral, they are illiquid assets, and it would take time for the bank to kind of sell them and recover their money. So they would charge higher interest to you. And also duration of lending, that means the higher the duration, the more the time period of the loan, the more the risk to the bank. Why? Because the more time you hold the money of the bank, so bank has a higher risk because you have taken the money of the bank and you are doing a business, but bank has given to you and bank expects that money from you. So the duration, for a higher duration, for if you take a loan for 5 years, the interest would be less, but if you take loan for 30 years, interest would be high. Okay, just a second, I'll have some water. Okay. Okay, just a second. The term structure of interest rates, the term structure of interest rate refers to the way in which yield on a security varies. See, what do you mean by yield? What you earn from your investment in a bond is nothing but your yield. Okay, you put 100 rupees, and now the company is paying you a coupon of 10% accepted. You would get interest, but apart from that, if you sell that bond, if the interest rates in the market have just gone down to 8% and your company is paying a coupon of 10%, so you will sell the bond at 120 at a higher price because your bond will have a high demand in the market. There is a negative relationship or an inverse relationship between the interest rates, market interest rate, and the bond price. If the market interest rate is high, the bond price would decrease. Why? Because like suppose the interest rate is like, suppose the bond is like the bond value is, suppose you have invested in a bond and you are supposed to get 100 on maturity, 10% is the coupon. Okay, let's take this is a bond you bought at 100, 10% is the coupon what company is offering you, and in the market the interest has gone up by, for let's say 12%. So now you would like to shift to some another bond. Why? Because in the market the interest rate is high and your company is paying less. So what would happen in this case? What would happen is, if you need to sell this bond, you cannot sell at a higher price because the demand for this bond is less in the market, and you have to sell at a lower price. Okay. So like in this case, this relationship what I'm showing here, so you need to sell the bond at $80. Why? Because the one to whom you are selling will not accept uh, like if you're selling this bond to someone, okay, they will not accept the bond at 100. Why? Because in the market, if they are investing, they're getting 12% for bonds which are of same characteristics like this bond. Okay, so when they're getting a higher interest rate when they invest in some another company, why would they invest in a company which is paying them 10%? So they would ask a lesser price in this case, and 12 and then what would happen? 80 into 12%, somewhere around 96, or 10% on 100, 9.6 for example. 10% on 100 is 10. So near about they are getting the same interest. Okay, so this particular point is proved. When the market interest rate is high, the bond price would decrease, and when the market interest rate is less, the bond price would increase. Okay, now, so the term structure of interest rate refers to way in which the yield on security varies according to the term of borrowing. The interest rate for different maturities of a debt security can be shown through the yield curve, yes, which I'm going to show you right now. Normally, the longer the term to maturity, the higher the interest rate. You can see here, normal yield curve. As the term to maturity is increasing, you can see, suppose these are the interest rates. If I put like 8, like suppose 2, 4, 6, 8. So you see, if the term to maturity is 1 year, what is happening? Like you see the interest rates here. If the term to maturity is 2 years, you see interest rate here. If the term to maturity is 3 years, you see the interest rate. 4 years, you see the interest rate. Like that, it goes. Okay, it will be always upward sloping. Why it is upward sloping curve? If the term to maturity is going on increasing, the interest rates will be going on increasing. So here we are. Normally, the longer the term to maturity, the higher interest rate, and occasionally interest rates may be higher for short-term maturities than long-term maturities. Okay, because of the high demand for short-term securities, the interest rates may be high. Okay, because people show a lot of demand for short-term securities. Why? Because the short-term securities carry a higher interest rate, and long-term securities right now carry a lower interest rate. But what would happen as the time proceeds, the short-term maturity bonds, they would get a return here, and they can reinvest in this long term. Why? Because in the future, as the time progresses, long-term maturity securities interest rates will be going high, like 7%, 10%. So they can get a good benefit in the future. Uh, if they invest in long-term maturity securities in the long term, not in the short term. Because in the short term, if they invest in short term maturity securities, they are getting a higher interest rate. That interest rate plus principal what they are getting, they can reinvest in long term securities and earn a good interest in the coming future. Because in the long term, the interest rates would go high. Okay, since in the long term the interest rates would go high, and in the short term the interest rates are less for long term securities, and for short term securities the interest rate is high, you see a negative yield curve. Okay, which we can see here. So what is the downward sloping curve? The downward sloping curve is during the short durations. During the short durations, if the interest rate is, for example, for 1 year, see, this is a different case. If I take a 1 year security, I'm getting a 6% interest. So I would invest in this security rather than investing in a security for which the maturity is of 5 years. Okay, and the interest rate would be less. Correct. So in the beginning, when the short duration securities are giving me higher interest rates, I will try to take advantage of this scenario. And with this investment, if the maturity is 1 year and I get my returns, right now the long term maturity securities have a lower interest rate, so I can invest on them, and they would gradually, as the time passes, in the future they may give good returns, but right now they are not giving. Please understand, till 5 years also it is short term. Long term is 20, 30 years. Got it? So since the long-term security long-term maturity securities, please understand, since the long-term maturity securities have a lower interest rate. See, if fifth year, what's the interest rate? Somewhere around 4%. Is having less interest, people will not want to invest in long-term securities, and the demand for that would be down. And for short-term securities, the demand would be high, and the people will be trying to invest in short-term securities more. That's the reason why you see a curve is higher here, and slowly, steadily, the curve would go downwards. Why it is going downwards? Because of the low demand of long-term maturity securities. Okay, here the demand of long-term was high, here the demand of long-term is less. So when the demand is less, the curve would go downwards. Demand is high, the curve would go upwards, because here higher returns are expected, so higher demand. Lower returns are expected in long term, so lower demand. But in short term, the demands are high, the returns are high, so demand is high. So here, from here, the things are starting. Okay, here the point what we are seeing is the point whereby indifferent point, I can say, like long or short, anything is all right. But again, slowly, steadily, the things are going down. So what is liquidity preference theory? Liquidity preference theory is nothing but you are giving more emphasis to such securities on which can be easily converted to cash. Okay, so like in that securities you want to invest, correct? So provides a reason why in theory the yield curve is normally upward sloping. So that long-term financial assets offer a higher yield than short-term assets. So here we are giving preference to liquidity, more cash, more returns in the future. So we would put more money into long-term securities, henceforth their demand would be higher and it will be upward sloping. Liquidity preference means that investors prefer having cash now to deferring the use of cash by lending or investing it. Investors can prefer having cash sooner to having cash later. Okay. So they therefore want compensation in the form of higher return for being unable to use their cash now. Of course, that's the reason why we see a higher interest for the long-term securities. So now the required return increases with the length of time for which the cash is unavailable. Because of this, long-term interest rates such as bond yields tend to be higher than short-term yields, and the yield curve slopes upward. Why? Because you are preferring a good amount of return in the coming future, and since you are putting your money for a long period of time, you definitely expect a bigger amount in the future. Hence the preference for you is liquidity in the future. You put your money into longer term securities, and the interest rates would be higher in the near future, and the curve would go upwards. Expectation theory, see, states that interest rates reflect expectations of future changes in interest rates. If interest rates are expected to rise in the future, yield curve is slow upwards. If not, then downwards. Simple. Market segmentation theory, people want to put them in one sector, one market. Okay, so of suggests that slope of the yield curve will reflect conditions in different segments of market. So right now the software market is doing well. If you put into software companies, you'll get a good return in the future. Okay, so this theory holds that major investors are confined to a particular segment of market. They don't change the segment, it seems. They would put in a particular segment where they expect good returns in the future, and that's what they do. And government policy on interest rates may be significant too. See, on treasury bonds, if the interest rates are increased by the government, other securities would also increase their interest rates. If the treasury bond, which is the treasury bonds are nothing but these are the bonds of the United States government. If the interest rates would go down, the other private companies would also have to decrease the interest. That's what. General level of interest rates. So see, already I have explained you real return is nothing but if I take nominal return and deduct the inflation from that, you get the real return, correct? Or real return plus inflation would give you normal return. If you invest in long term maturity securities, you expect nominal return because inflation is also considered in that. Why? Because inflation is expected in long-term security, long-term maturity securities, because in a long span of time things can change. Inflation can be expected, and that has to be incorporated. So we expect nominal return. But in short-term securities, we expect only real return. So liquidity preference of investors and demand for borrowing already we have discussed. For long maturity securities, high interest rates. Balance of payments, when a country has a continuing deficit, that means its imports are more and exports are less. That is balance of payments. That is a deficit case. And the authorities are unwilling to allow the exchange rate to depreciate by more than a certain amount. Interest rates may have to be raised to attract capital into the country. So what they are saying, please understand. So we have a very, very high import. Okay, suppose I'll take the classic example of India and United States. Okay, let's take UK. Fine. All of you are following. It's a very interesting chapter. So now what we see is in India, I have already explained you the concept of interest rate parity in the previous past. So what is happening? India is exporting lot to UK and UK is importing from India. It has created a pressure on UK's currency because Indian currency is in very high demand right now because lot of money has to be paid from the UK to India. So they would take pounds to the market, to the bank, convert pounds into rupees, and then they have to give rupees to India. So they would demand rupee. So with this, what happens when the rupees demand is high, rupee appreciates, and pounds demand is less, pound depreciates. Now what they should do? So they now, if they have to attract the investment in their country, they would raise the interest rates. Why they would raise the interest rates? If in India the interest rates are suppose 4% and in UK the interest rates are 3%, if they raise it to 7%, lot of people would again invest in UK now to get higher returns. Why? Because this is called creation of demand of their currency. So if the higher returns are expected in UK, more people would invest in UK because they're getting 7%, correct? So this would again drive up the demand of the UK's pound, and then they can try to balance the deficit, correct? Now, monetary policy is nothing but increasing the interest rates. That is one of the best things. Why? Because if the inflation is high, the interest rates would have to be increased to control this inflation. Why? Because people would deposit more money into the banks and they would spend less, and that would make the economy or the banking structure very stronger, and the inflation can be kind of controlled with the monetary policy. Interest rate risk management. So now we have already seen different scenarios whereby we have seen the interest rate risk. Now we will see how to manage this interest rate risk, or how to hedge this, or how to reduce this. Okay. Now, asset liability management. So what we can do, fixed interest rates for payments or earnings may have different maturity timescales. Of course, asset and liability management aims to achieve similar durations for payments and earnings. That means if I have a payment of suppose $10,000 interest, I should also have a receipt of $10,000 interest. So interest received and interest paid how it would go is, I would receive $10,000 interest and I would pay $10,000 as interest. So this would kind of reduce my risk. Okay. That is what is called asset liability management. So you are kind of matching your payables with receivables. So similar maturity securities can help you in this case. For example, they have given an example even. Say a business has a 10-year mortgage on a building at a fixed rate of 5%. It rents out the building for 6 years at a rate of 7% per year. This is fine for 6 years, but then if the rental yield falls to 4% per year, the business will start to lose money. A safer option would have been to match the loan period to the rental period. That's what. So if you don't match it and do like that, if till the time the matching is all right, you would enjoy the benefits. But when the matching like the maturity of this is before than the 10-year mortgage, okay, see what is happening. This is fine till 6 years it seems. So what has happened is, this is 10 years mortgage, but rents for the building you are taking for 6 years. Till 6 years you are able to manage things, but after that if the things go down and you need to pay a higher interest on mortgage, okay, so that is not good. So you should do a perfect match and of the asset and liability, so whereby you can, the receivables what you get, the payables you can easily pay off with that matching. Okay. Now Matching and smoothing are two methods of internal hedging. Internal hedging is nothing but companies do this internally, used to manage interest rate risk. Matching is where liabilities and assets with common interest rate are matched. That is common interest rate. See here, the interest rates were not common. It was 5% and 7%. Okay, so the receipts, whatever you have, maybe some 10,000, and the payments, whatever you are supposed to do. Example, just a second. Was suppose 12,000. Okay, something you are able to manage. Okay, but if it is perfect, you are able to manage fully. That's what they're saying. Now, for example, okay, this is what the example which I've given you is kind of matching with this. That's understood fact. Excuse me. Just a second. It's like kind of 2 minutes. Yeah. So for example, subsidiary A of a company, so here is a parent, here is a subsidiary, might be investing in money markets at LIBOR, and subsidiary B is borrowing through the same market at LIBOR. So they are investing in LIBOR and they are borrowing at LIBOR. So if LIBOR increases, subsidiary A's borrowing cost increases and subsidiary B's returns increase, and they can match it and they can pay off, correct? They can kind of net it. Okay, net is nothing but they receive and they pay. That's it. Smoothing is where a company keeps balance between its fixed rate and floating rate borrowing. So some loans or deposits have fixed rates of interest and some have variable rates. So a rise in interest rates will make the variable rate loan more expensive, but it will be compensated for by the less expensive fixed rate loan. So what is happening here? Please see. So smoothing is nothing but company keeps a balance between its fixed rate and floating rate borrowing. So fixed rate is suppose 5%, floating rate is LIBOR plus 1%. For example, if the LIBOR increases, the floating rate increases, and the LIBOR is suppose, for example, 5% right now. Let's take like that. Now what's happening? So some loans or deposits have fixed rates, okay, and some have variable rates. So a rise in interest rates, suppose the interest rates are rising, this gonna go for market, it's gonna go for 7%, and here it's fixed. Fine, for you it's fixed. In market the things are increasing, and LIBOR would also increase. So this variable would, because if the interest rates rise, in the case of fixed you are paying 5%, so this is good for you, but here you are paying more. Okay, so here you are saving 2% than paying, here you are paying more. So what is happening? Variable rate loan become more expensive, but here the interest, if you are paying a higher interest of 2%, that is compensated with less interest which you are paying in the case of fixed rates. Okay, that's what. Now comes the forward rate agreements. Very simple. You know that you have already done the forward contracts, correct? What happens in the forward contracts? I would tell you. See, very good example of forward contract is, so there is A and B. So A thinks that let me give an example and then also give you a forward rate agreement example and do a question. Just a second. After 15-20 minutes session, we are going to wind up. A is a speculator, B is a hedger. A thinks that suppose A is a baker and he always purchases wheat flour from B, who is a farmer, and A thinks that if he gets that wheat flour at cheaper rate today, he can take advantage of the cheaper wheat flour and make cakes and sell in the market at a higher cost because the raw material has costed him less. Okay, farmer is always worried that if whatever he is going to sell, that product or the raw material he is going to supply, the cost, the rate of that should not go down. He should get the minimum value of that. Okay, suppose let's fix the wheat for 1000 kgs, sorry, 1000 rupees per bag. So now farmer says, so farmer is kind of he is growing the crop right now. After 3 months the harvesting season comes, he will kind of harvest the crops and he would be ready with his wheat flour. Okay, so 1000 rupees per bag for wheat flour. So farmer thinks after 3 months when he's gonna sell that wheat flour back to A, the baker, he should get minimum 1000 rupees. Okay, he is not aiming for a higher price. He doesn't want to do that. He's a farmer. But baker says, and the farmer says that if the price is 1000, he would be satisfied. If the price would go down, he would be in losses. Baker says, fine, if he gets the wheat flour at 1000, that would be great. Why? Because he expects the price of the wheat flour to go up, because as the time progresses, Christmas is going to come. For example, the demand for cakes would be very high in the market, and the wheat flour can be sold at a higher price. So suppose he thinks that the price of the wheat flour is going to go 1300 rupees per bag. So now what he does, he and farmer, they both sit together and they make a forward contract fixing the price to 1000 rupees per bag. Both are happy with this price. Baker is happy. Why? Because after 3 months, if the price of the bag goes to 1300, he's not bothered. He'll buy at 1000 and he can try to get that 300 rupees extra earnings with his by selling the cakes at higher amount. Okay, and farmer is also happy. Why? Because if the price goes down, he's not worried, because he is gonna sell at 1000 rupees only. Okay, now what happens after 3 months? Now they are not exchanging anything. They have just made a contract. After 3 months, the time has come. Now baker and farmer, as per the agreement, has to fulfill their obligations towards each other. So what happens? The farmer on that day after 3 months, the price of the wheat flour is 1000 rupees. It has not gone up. So baker, you would think that baker is at loss. No, baker is not at loss. He will take that at 1000. Okay, and farmer is also all right. Fine, he is also selling at 1000. But what if scenario number 2? What if the prices go down by 600? So farmer is not at loss now, because farmer would sell at 1000 only, what he has agreed with baker. Okay, because one party's gain is another party's loss. Fine, but baker is also all right, because baker did not have this in mind that the prices of the wheat flour is going to go down. He already has things in his mind that prices are going to go up, and like what has happened is market has not been performing as per the expectations of the baker, and it happens at times. So baker is also not kind of unhappy, because he is like all right with this, and because he already knows that the price was going to go up and he himself fixed that price. So fine, now what has happened, the contract is fulfilled, and something which is of 600 now will be sold by the farmer at 1000, and farmer will make a profit of 400. Okay, so now this scenario, this particular thing is called forward contract. This is forward contract. Okay, I'll write it here. Now let's come to forward rate agreement. What is this forward rate agreement? It is nothing but, this is me. I want to take a loan after 3 months. Okay, for next 3 months. So I'll say 3/6 FRA. What is this 3/6 FRA? I want to take a loan after 3 months for next 3 months. Okay, so we will write that in this way. So now what is happening is, what am I doing here? I am just fixing the interest rates today itself, because I think that the interest rates are going to go up in the future. So today the prevailing interest rate in the market is 5%. I think the interest rates after 6 months are going to go up to 9%. So what I would do is, I would go to the bank today. I will say to bank that after 3 months I want to take a loan of 1 lakh rupees. from you, and I want to fix the interest to 5% because I think the interest rates are going to go up. In the reverse, bank thinks the interest rates are going to go down. See, always this should be the mindset. In when you go to a market as a customer, you would think the rate should not be high, but seller would think the rate should be high. You always want to pay less. Seller always want to charge high. In the same way, in this case also, bank, if you are worried that the interest rate is going to go up, bank is worried that the interest rate is going to go down. So you and bank fix the interest rate to 5% as per the agreement. Now after 3 months you go to bank, you take the interest, you take the loan of 1 lakh at the rate of 5% interest for next 3 months, and the interest rates have increased by 9%. Now you are paying how much interest to bank? You are paying 5,000 instead of 9,000, and you are saving 4,000 rupees of interest. Correct? This is nothing but the forward rate agreement way of protecting or like saving yourself from a increasing interest rate in the future. Same like the forward contract, but here it is forward rate agreement. Why? Because you are fixing the rate. You are making an agreement with the bank and fixing the rate. That's it. There it was amount of 1,000 rupees. Here it is the interest rate of 5%. That's it. Okay. Hopefully you understood the concept. Let's go ahead. So please read this question. We will solve this question. Okay. So now let us see this. So Lin PLC is a UK listed company. It is 30 June. Lin will need a 10 million pound 6-month fixed rate loan from 1st October. See, understand the terminology. It is 30th June right now. And Lin will need this much loan, 6 month, that too this much loan, this much amount, 6-month fixed rate loan. That means he would take this much but at a fixed rate from October 1. So June, July, August, September. So 3 months, after 3 months. Okay. Lin wants to hedge its exposure to the risk of a rise in the 6-month interest rate between the end of June and October. So he wants to protect himself like against the rising interest rates. That's the reason why he is going for a fixed rate loan. So everyone should do that using a FRA, forward rate agreement. The relevant FRA rate is 6%. So he wants to fix it for 6%. We are going to see two scenarios. Let's see the question. On 30th June, and the reference rate for FRA is the 6-month LIBOR rate. 6-month FRA, the current 6-month FRA rate is this. So you want to fix it for this, but the offered rate is going on in the market at 6.25. Correct? Now let's go ahead. Now, state what FRA is required and what is the result of the FRA and the effective loan rate if the spot 6-month LIBOR rate is this and this, if the rate is 5% and if the rate is 9%. Let's see both the scenarios and see how he has hedged himself. So this is the FRA required is 3 to 9. How? Today is 30th June. He wants to take a loan on October 1st, and that too from October 1st for 6 months from October. So from June to October is 3 months, and from October to next 6 months is 6 months. So we can say 3 to 9. He will take a loan after 3 months for the next 3 months. That makes 3 to 9. Okay, this is the, see, he is going to take a loan after 3 months for next 6 months. Okay, so the agreement he has made like today, that is June, with the bank, that he will take a loan after 3 months for the next 3 months, for the next 6 months. So 349 FRA. Okay, 349 FRA. What is the what do this 349 FRA mean? The meaning is, see, it is for a period beginning after 3 months and lasting for the 6 months. Did I say the same thing? He is going to take a loan after 3 months for the next 6 months. Okay, so 3 to 9. Now the same terminology I used here for FRAs, that is the terminology they use. Okay, you should understand this point. Here I took the same thing, loan after 3 months for the next 3 months. So 3 to 6 FRA. Now so Lin has a fixed effective borrowing rate with FRA, even though it may not be borrowing with the 10 million from the bank that has arranged the FRA. So now what we would see, so Lin has fixed the effective borrowing rate, that is 6%, correct? And even though it may not be borrowing the 10 million from the bank that has arranged the FRA, right now he is not borrowing, he will borrow in the future. Now let's see the next point. So if they ask you the question, what is the FRA required? It is 3 to 9 FRA. That is, he is going to borrow after 3 months for the next 6 months at the rate of 6%. If the 6-month LIBOR rate on October 1 is 5%. So what is happening? Please tell me now. Just a second. If you have fixed for 6% and the rate in the market right now is 5%, so what is going to happen? The LIBOR rate will have fallen since 30 June. FRA is a binding contract, so you don't have any other alternative. You have already fixed it for 6%. In actual, there is no actual lending. So here there is no lending happening. This is just a agreement. Okay. So instead, Lin makes a payment for the difference between the interest for 6 months at FRA at the rate of 6% and the spot rate 5%. So now now the interest rates have gone down. It's gone to 5% and you have fixed 6%. So you are going to make the payment now, additional payment of 50,000. Tell me yes or no, did you understand? If the interest rate falls, it is loss for you, correct? Tell me yes. Yes. Now, next point. Let's suppose the Lin is able to borrow for 6 months at LIBOR rate. It will borrow 10 million October 1st for 6 months at this was at the fixed rate. Now we are assuming at LIBOR rate. So for 6 months at an interest rate of 5%. Taking the cost of the actual loan interest with the cost of FRA, the effective cost of borrowing for 6 months is an annual 6%. So let's see FRA payment. He is borrowing for 6 months, 10 million, he is going to pay this much interest, and interest payment on actual, this is the FRA agreement he has made. Okay, but actual what he is going to pay 2,50,000, correct? So the total what he is going to pay is 3 lakhs, and that is equivalent to effective interest rate of 6%. Fine. Now let's see the scenario number 2. If the interest rate have gone to 9% and you have fixed it to 6%, so are you going to pay more or less? Please tell me. Of course less. You are going to save how much? You're going to save how much? Please tell me. Hello. See, you have saved yourself from the higher interest rate, na? You have fixed it for 6% and the interest rate in the market is 9% right now. So you have saved yourself by making a forward rate agreement. So now will you pay more interest or less interest? You will be paying as per 6 lakhs. 10 million into 6%, 6 by 12 is how much? Somewhere around 3. 10 million into 9%, 6 by 12 is how much? Somewhere around 4.5. So you are going to pay 1.5 less, correct? Correct or wrong? Yeah, so this is what you're going to save. This is a receipt for you. Actual payment of the loan is at the rate of 9%, which is in the market 450. Net payment is this, again 6%. Okay, that's what. Now let's go for the interest rate derivatives. See, derivatives, we have already discussed about derivatives. In that, the first is interest, like you can take interest rate futures, and you can also make interest rate swaps. There are also interest rate options, and there are also interest rate swaps. See, don't worry about interest rate swap. So what I'll do is, to help you out in case of interest rate swap, I will send you a very good video right now, which will explain you everything in very details, in a very detailed manner about the interest rate swap. You will never forget it. Okay. Right now we will discuss about these kind of derivatives. See, interest rate futures are nothing but, you know already about the futures contract, whereby there you used to there used to be a same, we can take same forward rate agreement between two parties. Instead of forward contract, we would say forward futures contract. So what is in futures contract? Same thing. You are making an agreement with another party, and you want to buy something, and the other party will have to sell something, and you make the contract today itself, and the future you're going to execute the contract at the price which you have fixed as per the futures contract. Same thing comes for interest rate futures. Instead of money, you are fixing the interest rates right now. Instead, suppose you are fixing a interest rate for something at 5%. In the future, you are going to, as per the futures contract, you are going to take a loan or something at 5%. Okay, that's what you are fixing the rates. See how it happens. So you want to take a loan in the future at some interest rate which you want to fix it today, and that interest rate definitely would be lesser interest rate, because if you are a speculator, suppose, okay, I would come here instead of this. Let's see what example they have given. Yeah, see, actually interest rate futures are very similar to FRA, but the only difference between the forward rate agreement and interest rate futures is, futures are standardized contracts. There, if you want to uh, fix some interest for some loan which you are going to take in the future, there should be minimum loan what you should take is this much, at least. That means they will standardize the things. If you want to fix the interest rate as per the interest rate futures, minimum loan what you need to take is this much amount. So that you need to understand. Okay, that is what was about the interest rate futures. And interest rate, see, I will always tell you, interest rate futures, always you should make an interest rate futures contract at a lower rate. If you fix at 5% and in the future the rate goes up to 9%, it is better you can take a loan at 5% and pay interest at the rate of 5,000 if the loan you are taking 1 lakh instead of 9%. That way you are saving your money. Now interest rate options. See, interest rate options are also similar to interest rate futures, but here what is the difference between futures and option is, futures are binding contracts. Here, if you make a future interest rate futures contract with the bank, if the interest rate you have fixed it 5% and the interest rates have gone to 2% when the contract has to be executed, you have no other option but you need to execute the contract. You need to execute the contract. I will give an example of interest rate options. Don't worry. See what happens. Here I have gone to a bank and made a contract with bank that I want to borrow 1 lakh after 3 months for 5%. The rates have gone to 9%, and now I can borrow at 5% and pay the interest of 5,000 to the bank. Okay, I'm not concerned with this. So I save 4,000 here. But if the interest rates have gone down to 2%, even though I need to pay 5,000 to bank, here I lose. But in case of options, it is not like that. You have an advantage. If you have gone to bank and you have fixed a rate of 5%, and the interest rates have gone up to 9%. This is called interest rate cap, I think. Just a second, I will tell you. There is cap, collar, and something is there. Yeah. So interest rate cap is option sets an interest rate ceiling. Ceiling is the higher limit, lower limit, floor. Okay. Collar is buy an interest rate cap and at the same time sell interest rate floor. Okay, I'll tell you what this is. I'll give an example for this. Okay, I'll give an example. See, instead of reading that theory, if you know the practical examples, easy for you to solve. So now interest rate options. So I have fixed the interest rate at 5% for loan which I'm going to take after 3 months. If the interest, so this is, I'm speaking about interest rate cap. Okay, I have fixed a ceiling limit. That means I want to take at 5%. Just a second. Lower limit. Acha, floor and cap. Cap is highest limit and floor is lowest limit. Okay, so this is suppose floor, for example, floor. This is the lowest limit I have fixed, 5%. Lowest limit is, and this is the minimum price. Okay. This is cap. Just a second. Please be online. Hello. Yes, what happened? Okay, I'm continuing. 2 minutes. Yeah, 2 minutes. Just wait. Almost about to finish this. Yeah. Okay, fine. So interest rate cap is like call option, and interest rate floor is like put option. So already you should be knowing some good details about call option and put option, correct? So here what happens is you take the interest, you want to take a loan after 3 months. You want to take a loan after 3 months of 1 lakh rupees. You want to take a loan after 3 months from the bank at 1 lakh rupees for 5%. And if the interest rate goes to 9%, you are going to pay 5,000 only and going to save 4,000. This is the benefit you have. But if the interest rate goes to 3%, you are not going to exercise the option. The option becomes worthless. That means in case of options, which is, there is no obligation you have to definitely fulfill the contract. Okay, but in case of futures, there was a obligation. If the interest rates have gone down, you have to take the loan, whatever the case may be. Why? Because it's a binding contract. Option is not like that. If it will go up, then you will take a loan at a lower rate and you will save your money. But if the rate goes down, you're going to lose money because you're going to pay a higher amount, and whatever is of not benefit to you, that means wherever you have a loss, you would not exercise that option. You would let it lapse because the option is worthless. That is the only advantage what you have from the options contract. Okay, please try to understand. Now point number 2, I was speaking about interest rate floor. Just we are done with. I'm going to send the swap video right now. Interest rate floor. See, what is interest rate floor? So you have fixed an interest rate of 7% of some loan which you are going to take from the bank at the rate of, that is 1 lakh rupees. So now the interest rate, if it goes up to 9%, definitely, just a second. So if it's going to go to 5%, you are not worried. Why we are not going? You are not worried because if you have set 7% and interest rates are going to go down, okay, sorry, interest rates are going to go up to 12%, no, okay, go down to say 5%, and you will enjoy this thing, okay, you will pay at 5%, you won't care about the 7%, correct? But if it's going to go up to 10%, you're going to pay only 7%. That is interest rate floor. You have fixed a limit here. You have fixed a limit of your interest rate, okay? If it is going to go down, you are not at profits. Why? Because you are paying a higher interest, okay? So if it is going to go down, it's like somewhat tricky. Put option is what? Suppose if you have fixed some price of something for 100 rupees, and if that thing goes to 70, you will still sell it at 100. This is the option to sell. That was the option of taking a loan, and this is the option to sell. So bank, for example, bank. So now this option is given. This is the option whereby option contract between the bank and you, as per which bank has fixed the interest to 7%. Okay. Now, if the interest rate goes down to 5%, still bank is going to give you the loan at what rate? 7%. Tell me yes or no. Hello. Yes, Shubham. Shubham.
Yes, sir. Yes, sir.
What is that? See, you have gone to bank and made a contract, and the contract between you and bank is the option contract at the rate of 7%. So if because bank is worried about the interest rates falling down in the future, so bank now will give you the loan at what rate? At 7% or 5%, even though the interest rate goes down at
7%.
7%. That is the floor. Okay, and last is the collar. What is collar? So collar is nothing but the borrower can buy an interest rate cap. That means if I am a borrower, I will take the loan at 5% interest. Okay. And at the same time sell an interest rate floor. I will take the loan at 5% interest. Okay. And the loan what I have is like 1 lakh. I will wait for the time where the interest rate goes to 9%. So still I will be paying only 5%. And simultaneously what I can do is if I have some money, okay, I have some money, I can sell the interest rate floor. That means I can fix a rate to 7% with some other person and give him the loan at 7% even though the interest rate goes to 4%. So here what is happening? Here I am paying less interest, and here also I'm making benefit. Why? Because when I sold the interest rate floor, I fixed the rate at 7%. So even though the interest rate goes down to 4%, I am going to charge 7% from the person with whom I have made the contract. So that is what is the benefit here. I save 4%, here I make 3%. So both the ways I'm making benefits. Okay. So this is buying an interest rate cap, and simultaneously what I'm doing, I'm selling an interest rate floor. So it can be like this also, like yeah, this is the best example which I can give you. So here also I made a good profit. And when I see what is happening, when I bought the interest rate cap, I paid a premium to broker of $10. Here I'm charging a premium of $10 from the person whom I'm selling the interest rate floor. That means I bought the interest rate cap. That means I fixed the interest rate at 5%. If the interest rate goes to 9%, I'm going to pay 5%. I'm going to save 4%. Simultaneously, I sold interest rate floor. That means I have money right now. Correct? I have money. So I have money. So what I did is I fixed the rate at 7%. If the interest rate goes down, I am going to get 7%. So 3% I'm earning here. So what I'm doing is what I'm paying, and I'm trying to earn from the both ways. Okay. So this is the way I can do. And the last and final thing which is left over is interest rate swap. So interest rate swap is nothing but I'll give you a small example and also a video. Okay, so that because interest rate swap is just a theory for you. See, interest rate swap is nothing but this is A and this is B. A has taken a loan from HSBC Bank. B has taken a loan from HDFC Bank. A has taken a loan from HSBC. He has approached the HSBC for loan. He asked HSBC to give him loan at fixed interest rate, suppose 7%. But HSBC denied. HSBC said, no, you don't match our criteria. Your creditworthiness is not good, and we find that it is risky to give you loan at fixed rate because your profile is somewhat risky. So we would go for floating rate loan. So like he did not get what he wants, and he got a loan at LIBOR plus some like 1%, for example. So he needs to pay floating interest rate to HSBC, okay, for some 10 lakh rupees. B has also taken a loan from HDFC, and B got a loan at fixed rate of 7%. For example, acha, let me not do all these things. Let me just make simple things. A got loan from HSBC at 7%, okay, fixed rate. Let us make simple. B got a loan from HDFC at 10% floating rate. Okay. So who is paying fixed interest to HSBC? A. Who is paying floating rate to HDFC? B. A is worried that if interest rate goes down, he needs to pay. If interest rate will go down to 4%, he still needs to pay 7%. So he's worried. In his market, this can happen. B is worried that if the interest rate goes up, he needs to pay a higher interest. If it goes to 12%, he needs to pay higher interest. So what both of them discuss is, let us swap this interest payments. That means if A is paying fixed to HSBC, A would make a swap agreement with B, as per which A is paying fixed. Okay. He's paying fixed. He's fed up with fixed. Now he wants to shift to floating rate, and B is paying floating. He wants to shift to fixed rate. So they both exchange their payments. A will be making the, now who is making here? Who is taking the floating rate? B. Who is making the fixed rate? A. So he wants to receive floating rate payments and wants to pay fixed rate. That's it. Okay. So what will happen? He is already paying fixed now. Now he wants to pay the floating, and he wants to pay the fixed interest. Understood? Hello?
Yes, sir, yes.
Who is paying the floating interest?
A.
B.
सर मतलब बाद में वो पे करेंगे, ठीक.
B is paying the floating rate interest to HDFC. A is making the fixed rate interest to HSBC. So A now wants to shift to floating rate, and B now wants to shift to fixed rate. So what will A do? A will make a swap agreement with B, as per which he will ask B to make floating payments to him. Correct? He will receive floating and pay fixed. Correct? And he will receive fixed and pay floating. Fine? Correct?
Yes.
Okay, let's take a classic example of a swap agreement. Simple example we'll take. Just give a small example, 2 minutes. Okay, let's take this example. It's a good one. So here fixed to floating interest rate swap. Okay. So let's take the loan interest rate example. Company ABC has this much loan with 5% fixed rate. company would prefer a floating rate. Am I right? Did I say the same thing? Who has the fixed rate ABC? So here company ABC has taken a loan of this much, okay, and he is already paying a fixed rate. So he wants what? Floating rate. And XYZ has taken this much loan with floating rate, and he would prefer fixed rate. So now who does the thing? So company ABC has taken a loan at fixed rate and would prefer floating rate. So company ABC agrees to pay XYZ floating rate payment. Correct or wrong? Because he's already paying fixed. Am I right?
Yes.
Correct. So company ABC agrees to pay XYZ an annual LIBOR of 2% of LIBOR plus 2%, and company XYZ agrees to pay ABC an annual fixed rate on notional this much. So now he is already into fixed payment, he is into floating payment. Now what is happening? ABC would agree to pay XYZ. He is into fixed now. He wants to pay floating. Correct? Correct or wrong?
Yes.
See what is happening. Uh, this is the loan amount. This is the loan amount. So ABC has to pay bank 5% fixed. But ABC is in what right now? Swap agreement with B. So when ABC is in swap agreement with B, ABC who is paying fixed rate to bank, okay, would agree to pay what? Like LIBOR of LIBOR plus 2% floating rate on notional principal. I will tell you what is happening. See who has taken a floating rate loan in this case? Who has taken a floating rate
AB.
loan?
Floating rate XYZ.
So now A is supposed to pay fixed rate to his bank. So A will take over floating payment of XYZ and B will take over fixed payment of ABC. That's it. Finished. Fine, correct. I will give you an example here. क्या हो रहा है? ABC
Got it.
XYZ, yeah. So ABC is already making a fixed payment to bank, and XYZ is already making a floating payment to bank, his bank. So when he is paying fixed, he wants to make the floating payment of XYZ, correct? And when he is making floating payment, he wants to make the fixed payment of ABC.
AB.
Are they exchanging their payments?
Yes, sir.
He is paying fixed. Now he is paying floating here. He was paying floating. Now he is paying fixed here. So they are exchanging the payments or not? They are exchanging the payments. That's it. So this is interest rate swap. Why they are doing that? Because they are fed up with their payments. They want to just get rid of that because they are scared that in the market of ABC, who is already making a fixed payment, the interest rates would go down. So he will pay a higher payment. And in market of XYZ is already paying floating. If the interest rate go up, he has to pay higher interest. So he will exchange fixed, he will exchange floating. He was already paying fixed, he will pay the floating of XYZ. He was already paying floating, he'll pay the fix of ABC, okay? Because ABC doesn't want fixed payments and XYZ doesn't want floating payment. What he doesn't want, he will exchange. What he doesn't want, he exchange. So he doesn't want floating, he will exchange with fixed. He doesn't want fixed, he will exchange with floating. That's it. Now I am going to send you a very good example of interest rate swap. I'll show you. Please go to that question. It's a practical question. And wind up this chapter. Done. Just a second. So please go through these examples. There are 2 videos. You will get everything in and out of interest rate swap. Okay, and also the profit and loss which is made in this particular agreement. Okay, sure. I'm sending that now. And Shubham, एक सेकेंड, so मैं आपको कॉल कर रहा हूँ एक सेकेंड. ओके, जस्ट अ सेकेंड. Okay, done with the class. Thank you.